Financial Masterclass, From Saving to Investing. Host Jack. Core message: saving protects your money, but investing grows your money. True wealth isn't built by just leaving cash in a low-interest savings account. It requires a strategic transition to investing. The wealth gap: saving versus investing. Many people feel financially mature when they save $100 or $200 a month. However, leaving a large sum like $10,000 in a traditional savings account earning 0.5% to 1% interest only yields about $50 to $100 a year. Meanwhile, the stock market, historically tracking the S&P 500, has returned an average of about 10% per year over long periods. The power of compounding over 20 years. Look at how the exact same starting amount of $10,000 performs over time based on where it sits. Savings account at 1%, $10,000 grows to approximate $12,200 after 20 years, chart decreasing. Stock investment at 10%, $10,000 grows to approximate $67,000 after 20 years, chart increasing. Warning: the seed analogy. Saving money is like storing seeds in a jar. You are protecting them, but nothing grows. Investing is like planting those seeds in soil. At first, it looks messy and you don't see immediate results, but over time, it grows into something far bigger than the original seeds. 2. The step-by-step path to transition safely. The transition from saving to investing shouldn't happen all at once. It should happen in calculated stages to protect your emotional stability and financial security. 1. Build a real emergency fund. 3 to 6 months of expenses. Before investing a single dollar, keep 3 to 6 months of living expenses in cash. This money stays in savings for unexpected problems like job loss or medical emergencies. It protects your investments from your own life, so you never have to panic sell. 2. Separate saving from investing. The two-bucket mental model. Mentally separate your money into 2 clear buckets. Bucket 1, safety money, does not move and stays liquid. Bucket 2, growth money, is allowed to fluctuate because its sole job is long-term growth. This reduces anxiety dramatically. 3. Start investing small. Habits matter more than timing. You do not need thousands of dollars to start. Many brokerage platforms allow you to begin with as little as $50 or $100. The primary goal at the beginning is not massive profits. It is building the consistent habit of investing. 4. Focus on simple investments first. Avoid complicated strategies. Skip day trading, options, and crypto speculation. Focus on low-cost index funds, which track the overall stock market. Instead of picking individual winning companies, you invest in hundreds of companies at once, ensuring automatic diversification and lower risk. 3. The math of consistency and handling market crashes. The most powerful investing strategy is actually pretty boring: consistent monthly contributions. The math: if you invest $300 per month at an average of 8% annual growth, after 25 years you will have roughly $285,000. Out of that total, your personal contribution was only $90,000. The remaining $195,000 comes entirely from compound growth. Handling volatility. Market crashes and downturns are completely normal. Long-term investors actually benefit from them. When prices drop, your fixed monthly investment buys more shares at a lower price, positionally strengthening your returns when the market recovers. 4. Summary comparison financial strategy primary function psychological state ultimate outcome saving a loan protects capital from risk feels safe, static, and predictable gives you stability investing wisely multiplies capital via compounding requires discipline through volatility gives you freed.